Hi everybody. I'm excited to welcome everybody to now the second day of ANHD's 12th Annual Community Development Conference. Our theme and our slogan is Fighting Forward, so fight forward. My name is Barika Williams. I'm the Executive Director at ANHD, the Association for Neighborhood and Housing Development. Before I get further in, I just want to thank the ANHD amazing staff who pulls all of these things off. So we do not put, please applause. We self-curate all of these 7 events that happen. So this is very like DIY, do it ourselves with our partners, with the organizations and organizers and members that we work with. Also, thank you to our board members who really have been supporting us throughout this, and our sponsors, which I'll talk about a little bit more later, who have supported this event and made conference possible. In particular, I want to thank our movement leader, sponsor, City, our community convener sponsor, New York Community Bank, who you'll hear from later, our neighborhood defenders sponsors, Wells Fargo and Goldman Sachs, and our lead law sponsor, Goldstein Hall. And the ANHD Board of Directors, who are all also sponsoring this series as a group. So it's really important. We can't do this and we can't pull off these type of events without that kind of support. For those of you who are new to ANHD, because I definitely have some folks who are new to us as an organization in the room, here at ANHD we work to build community power, to win affordable housing and thriving and equitable neighborhoods for all New Yorkers. We are 49. We will be turning 50 years old next year. We have been doing this for quite some time. And we are a member-based organization of community groups across New York City. We combine using research, advocacy, grassroots organizing, and technical assistance to really support our members and their work to build equity and justice in our neighborhoods, right? We're working citywide. We're working at the neighborhood level. Sometimes we're even doing stuff at an individual building level, depending on what's going on. But fundamentally, we believe that these things combine, and that housing justice is economic justice, is racial justice. And so that's how we address our work. I took over as ED at the helm here back in January 2020. So you can imagine it was a different first 2 years. But I'm really glad to be here with all of you in person as we're hosting this 12th annual conference. And this is year 2 of our reimagined and recreated conference format. So we moved our programming out of the corporate ballroom, out of the single day sort of traditional conference format, and shifted our format to be in community events and investing our capital and having conversations in our local communities and in our local neighborhoods, which is where we do our work and where our members are. So throughout the month of October, we'll delve into a series of different urgent topics and conversations, including, like today, on responsible banking, supporting small businesses and merchant organizing, the intersection of housing with other social issues, including homelessness and criminal justice or criminal punishment, depending on how you frame it, community-created public spaces, industrial business zones, and land use and advancing racial equity work in community development overall. So this year's conference events are in Kingsbridge, in Maspeth, in Ridgewood, in Harlem, in Flatbush, and today we're here in the Lower East Side. So you see, like, we're really getting out and getting around. We're hopping to different boroughs and different neighborhoods. It could be a lot. The team will tell you. Yesterday we're like, where are we tomorrow? But it feels good, especially after such a long time in COVID of many of us kind of being like hunkered down where we are to really get out and see our communities and have these conversations in the places where these issues are happening. And the purpose of our conference is really and these programs is to bring together a range of voices, catalyze discussion, and encourage people to have some critical engagement with these issues. So when we get to the end of the day, we'll also have some space to have some conversations at your tables or with each other, and that's by design. We know that that's not always a part of like conferences and convening spaces, but it's not necessarily all the time that you've got financial institutions and organizers and funders and developers and policymakers in the same room and space. And so we want to create the space for there to be some conversations between folks. So before I bring us into today's discussion, I want to invite up Beverly Meek, First Vice President and CRA Director at Flagstar Bank, formerly New York Community Bank, so for those of us who will call it one or the other. And I want to clarify for everybody before Beverly gives her remarks, but also because it's helpful to not get confused, that Flagstar and New York Community Bank are not one of the entities that hold Signature's multifamily portfolio. That's FDIC. So just to clarify, because sometimes it can be confusing in the press, they took over deposits, but they don't have the multifamily buildings that we're going to be talking about. I don't want anybody coming and being like, Beverly, I want a building. She doesn't have them. But they're here as part of our amazing conference sponsor team and the support that they've given ANHD and our members. So I want to turn it over to Beverly.
Okay. Good evening, everyone, and thank you all for coming out tonight. Again, my name is Beverly Meek. I'm CRA Director for Flagstar Bank. It's truly a pleasure for you to be here tonight and have this opportunity to talk to you. Flagstar is proud to be a community convener, sponsor for ANHD's 12th Annual Community Development Conference. And we'd like to commend ANHD for having these really important conversations right here in the neighborhood. So this event brings together professionals and nonprofit leaders from the community development sector for impactful conversations around a diverse audience, many different voices and key stakeholders, all of which are engaged in improving low to moderate income communities across the city. I was going to talk about Flagstar and our merger, but I think Marika touched on that. In December of 2022, New York Community Bank acquired Flagstar. This isn't the first time that Flagstar has been in New York. We've been here as a mortgage company for many, many years. So this opportunity allows us to offer a broad array of products, services, and really also get into the multifamily business, which is very strong with NYCB. So to date, we have provided funding to members of ANHD's Equitable Reinvestment Committee and other engaged in affordable housing, economic development, and other CRA activities, including NHS of New York City, NHS of Brooklyn, Central Bedford CDC, HCCI, Community Life, BSRC, the Greater Jamaica Development Corp., the Fifth Avenue Committee, and BSD-CRC, just to name a few of our outreach. Part of what brings us here today is Flagstar's increased focus on community investments and engagement. We are working to be an active partner with so many of you to ensure that the bank's products, investments, and resources are going to support New York's low to moderate income communities. We do aim to be accessible and to build bridges between banking and the communities that we serve. During the merger, Flagstar worked with many of you, especially ANHD and its Equitable Reinvestment Committee, to develop a community benefits agreement that was both strong and which would positively benefit directly New York City. This community benefits agreement was $28 billion over 5 years, $5 billion for mortgage lending, $21 billion for community development lending, and $542 million for small business. So given the conversations around the CBA, we were and remain committed to sitting down at the table to hear directly from community-based organizations working to address community needs. We renewed our commitment and investment in the New York Community Cares Fund, a philanthropic strategy started in 2018 that emerged from discussions and negotiation with community organizations like those in the room. The fund, which is administered by ANHD, supports neighborhood-based not-for-profit organizations which provide comprehensive, affordable housing and community support services targeted at risk neighborhoods. In addition, the bank continues to be committed to ongoing accountability when it comes to lending. Part of those efforts include having quarterly meetings with tenants living in multifamily buildings that we finance to hear about the issues they are facing in their buildings and proactively monitoring our portfolio across our databases, such as the Building Indicator Project, also known as the BIT Report, pulled together by the University Neighborhood Housing Program in the Bronx, better known as UNPHP. So we are also engaged in moving forward with our community impact projects, or CIP. This is an initiative which brings together many parties from the nonprofit sector, government, and others to address important community development issues in LMI communities. Given today's tough economic climate, we all know and are feeling the housing crisis facing New York City and the region. There is a pressing need for neighborhood level services to help stabilize neighborhoods and families who are at risk of losing their homes. Thankfully, Flagstar and ANHD know that a vital component of neighborhood stabilization is affordable housing and strong partnerships with entities that are genuinely interested in having a positive impact in challenged communities. That's why Flagstar is making these investments in the on-the-ground community level work, in down payment assistance, and affordable housing developments in our CIP initiatives, all of which helps to stabilize people's housing and which, for example, keeps senior citizens in their homes and other longtime residents in their neighborhoods. We will continue to work with community-based organizations that are working to help low-income families whom face the risk of displacement or homelessness. Count on us to be a strong community partner. So on behalf of Flagstar, thank you for all the work that you have done here and on behalf of struggling communities. And I also, before I leave, I want to just acknowledge Stephen Molina, who is now with Flagstar, and also Ronaldo Perez, who many of you know. Thank you.
Oh, thank you to Beverly, and thank you to Flagstar. I mean, I think many of folks in the room know that part of ANHD's work is to both collaborate with banks and investment in communities, and also to agitate with banks and around investment in communities, and to really say, like, we need you to do more, change, address, and really appreciate that. When we were having those tough conversations a few years ago, the reason that we're in this room together, and that New York Community Bank and Flagstar support us and created an initiative, is because they sat down at the table and answered the call, right? And said, neither side got 100% of what they wanted, but that's very different than some people who refuse to engage in the conversation. So appreciating that. So before we begin, I also want to thank our host this evening, University Settlement. For those who don't know, University Settlement is the first settlement house in the United States, not New York, the U.S. And they partner with 40,000 New Yorkers on the Lower East Side and in Brooklyn every year to build on their strengths as they achieve healthy, stable, and remarkable lives. Their Project Home program helps to fight evictions and displacement and stabilize neighborhoods in their community. And we do want to thank and appreciate University Settlement for their partnership and their space for hosting us tonight. I also want to give acknowledgement and shout out to our lovely meal tonight from women-owned small business Empanada Mama, our caterer for the evening, who supplied all of these delicious empanadas. I can't wait to eat mine. And one of the purposes of our conference that we sort of shifted to was to uplift our members and communities, and that includes our vendors. So one of the things we shifted to is really shifting our vendor dollars to MWBE and local folks. So we're proud to be prioritizing that as part of how we as a business are spending our dollars. So let's get to tonight's conversation. We're going to be talking about the stability and affordability of Signature Bank's New York City multifamily residential housing portfolio in the face of the bank's collapse. I'll say that Signature's collapse was not a surprise for ANHD. We have been working on and around the bank for over a decade, really calling out their faulty business model when it came to residential and multifamily lending here in New York City, which relied on predatory and speculative activities in New York City's especially multifamily rent regulated market. So we knew that this was a concern. You're going to hear from folks who were like literally doing this, week after week. But it paid, what they were, their Signature's activities in multifamily housing really paved the way for thousands of tenants to be suffering around unsafe conditions, being the victims of harassment, and being destabilized and displaced from their homes and communities. So it's a core topic issue for ANHD, and they were a core and standout bad actor for a very long time. So this is a conversation for us to focus on the tenant impact of Signature's multifamily collapse. And I want to highlight that because we may have some folks who are thinking about, we've got different voices, different roles in the room. This is an opportunity for folks who are interested in the portfolio. We know that you're not going to be able to get on the ground and see every single one of the buildings that you may be bidding on. You're probably not going to be able to get into Miss Alvarez or Miss Jones or, whoever it is, home or unit. But these are folks who can tell you what it's like working in and living in these buildings. That's going to give you a bit of a window into maybe what you can expect behind that front door that some of you all won't be able to see. And I think that's important for you to know as you're thinking about this as an investment. After the panel, we'll have a chance to reflect and talk on through some questions. But before we get to the panel, so they know this, right? Before we get to the panel, I'm going to bring up Sean Kahani, the Deputy Director of the Division of Resolutions and Receivership at FDIC. I want to thank Chair Gruenberg and the team at FDIC. I know Chair Gruenberg couldn't be here today, but this has been very different in how we've been having conversations with the FDIC, and this team has been really amazing at saying what's going on in New York, how can we work with and talk to community groups, how can we talk to tenants, and how can we talk to city and state government. So appreciate all that they have done with ANHD and UNHP and our Equitable Reinvestment Coalition. So I want to bring up Sean. He's going to give some remarks, and then after that, we will turn to our panel, okay? And we'll do maybe a couple of questions at the end of Sean's remarks because people may have burning, pressing questions.
Great. So can everybody hear me okay? Sounds like it. Well, first of all, I'd like to thank Barika for inviting us here, as well as Will, who's been working with us at ANHD. I'd like to give also a shout out to Jim Buckley, Jacob Udell at UNHP as well. They've been incredibly helpful in gathering the data that we needed and getting the on-the-ground intelligence we needed for what we were facing once Signature failed back in March. And we have also been working, I'd like to give a special thanks to city and state officials. We've done tremendous work on that front, working with both the state and the city, the mayor's office. This includes HDC, HPD, and of course the housing and community renewal at the state level. So with that, as everyone knows, Signature closed in March, and what Barika was saying, obviously, maybe not a lot of Signature fans are in the room, but regardless, with the failure and the subsequent transaction with Flagstar, most of the assets were retained by the FDIC. And so what that meant is that we were appointed a receiver. And our mission at the FDIC is really set on public trust. I mean, there's a tremendous amount of public trust that goes into the mission that we've had since 1933. In fact, we're celebrating our 90th anniversary this year. And so some of that trust is based on the principles that we have to follow, which is really the statutes that we have to abide by. And there's 5 statutes, okay? One is maximizing recoveries, other is minimizing losses. ensuring there's no discrimination, competitive environment, right? There's a fair competitive process as we wind down a receivership assets. And then the one that actually relates to a lot of people in the room here today is maximizing availability and affordability for low and moderate income families. So that is one of the 5 statutes, equally weighted, of course. So you might ask yourself, well, how are you going to do that, right? So one of the things we're doing is, again, taking a step back before I get into that. The portfolio is massive, right? $33 billion is out to market. Much of that is commercial real estate as well as market rate sort of multifamily. However, 15 billion of that is related to what we call rent control, rent stabilized, right? So, and we define that as a single unit in a building having a rent controlled, rent stabilized unit is part of this portfolio. So that 15 billion, or Section 8. So that portfolio includes that amount. And that's across 500, a little over 550 landlords, or what we'll term as borrowers, because again, we taking over loans, not the collateral itself. But the way we're going to accomplish this is really threefold. So while this marketing process is happening, the first step to ensuring that we can adhere to our statutes is to retain a significant equity stake. So that means we're not going anywhere, right? That's one way to do it. The second is the operating agreement. And for those that, that will ultimately see the operating agreement, what that basically is there for is to set the rules of engagement, right? So we're going to set the rules of how and expectations and incentivized structures for the types of behaviors that we will want a managing partner that would ultimately buy an equity stake. So while we hold a majority equity stake, there will be a managing partner. Really think about it as a servicer that would actually take over this portfolio for a long term. And then, of course, stringent monitoring, right? I mean, we're not just going to hold an equity stake and not ensure that the right things are being done. So with that being said, that's the way we have positioned ourselves to ensure that the portfolio is properly managed, and that hopefully we get the right partners with the right incentive structures and then the right outcomes. And that's really what we want to do. And this is something that came up because I've seen many of you before actually in tenant meetings too, and tenant association. I've met personally with every tenant group or association that has asked for a meeting with the FDIC. So, and I'm not a local, so I'm in DC, so I'm coming up for these meetings. But that it just shows you, right, we're really committed to hearing from the community. We have, of course, meeting with borrowers as well, but we want to get the full spectrum. So the last thing I kind of wanted to mention also is that we recognize that these aren't numbers. So some people have mentioned that to me, like 15 billion and how many units, how many borrowers. We recognize that these are people's homes, these are people's neighborhoods, right? So so when I say the public trust, they're having a tremendous amount of public trust that goes into our mission, and talking with community organizers like ANHD and others. It's for that reason, to make sure that we're transparent in the process, that we are reaching out to communities, and that we're making sure that we ultimately get this right. And that's the main mission for us at the FDIC, and what we're trying to accomplish with this portfolio in receivership. So that was basically what I was going to say. I don't know if we have time for questions or if there's a couple questions, but no questions? That's fine. No pressure. Okay. Hey, thank you.
Thank you, Sean. And Sean and Alex and the FDIC team, I think, are going to be here for a little bit. So if you had a question, but you're like, I don't want to ask it in front of the full group, fair enough. You can ask them. But I will say we've asked about 1,000,000 questions that we could think of, and then some, and they've been really great about sort of getting through all of them. So I'm going to bring us up to the panel. So I'm going to ask the panelists to go ahead and come up and take your seats. Thank you so much, Sean. Also, can we give Sean and FDIC a round of applause? So I'm going to introduce, maybe can you slide this way? A little bit more. There we go. There we go. I want to introduce John Henry, lead organizer of Northern Manhattan Improvement Coalition, or NIMIC, as many of us know NIMIC as. ANHD member, longtime ANHD member. I'm going to turn it over to John Henry, who's going to introduce the panelists, but thank you for being our moderator and also an amazing leader and organizer on this and many other topics for quite some time. So, yeah, I was going to say, I think we have a second, right?
Hello, my name is Jean Henry, and I will be the moderator for today's panel. I had my first experience with tenant organizing in 2012 when I participated in the ANHD Center for Neighborhood Leadership program. It was a apprenticeship and training program for new organizers, and during that time I was placed at the Fifth Avenue Committee, a community development corporation in South Brooklyn. A few years later, I returned to the Fifth Avenue Committee as their full-time lead organizer, where I focused on organizing around predatory equity. And currently, I'm the lead organizer with the Northern Manhattan Improvement Coalition. It's a settlement house in Washington Heights and Inwood. So last year for the ANHD Fight Forward conference, I was invited to participate on a panel on challenging modern-day redlining. In the housing world, we would consider modern-day redlining predatory equity or reverse redlining. Today, we are going to keep the conversation going from last year, focusing on how predatory equity has affected NYC tenants. Following the financial crisis of 2008, buildings across the city fell into foreclosure or were sold by longtime landlords. Often, the new owners took on enormous amounts of debt and used mortgage loans from banks to finance the purchase. Hoping to take advantage of an opportunity to profit, these new owners began aggressively displacing or pushing out rent-stabilized tenants with the goal of increasing rents using a wide range of harassment tactics. Some of those tactics include frivolous lawsuits against tenants, using construction as a form of harassment, making illegal buyout offers, and failing to provide tenants with heat, hot water, or repairs. They even used the weak New York State rent stabilization law as a tool for displacement by using preferential rent to displace tenants that didn't know their rights. Vacancy decontrol was used to remove thousands of units from rent regulation, and individual and major capital improvements were weaponized to raise rents for low-income tenants. Tenant organizing groups in New York City identify this behavior as predatory equity, which can be described as speculative and high-risk financial investments in buildings with the expectation of quick, large-scale profits at the expense of tenant quality of life and building conditions. According to the Stabilizing NYC Coalition, buildings that meet the criteria must have one of the following factors, at least one of the following factors. Have a high debt-to-income ratio, meaning the building was bought for a higher price than the rental income can support. High levels of turnover, both in rent-stabilized and non-regulated housing. A significant percentage of tenants complaining about harassment. Buildings in poor physical condition. Ultimately, affordable housing becomes unaffordable, or affordable to who? landlords tack on illegal fees, tenants experience loss of rent stabilization, and buildings exit regulatory programs like Mitchell-Lama. Many landlords also forced their buildings into foreclosure. These foreclosure proceedings took a very long time, and buildings had to live, or tenants had to live, tenants in those buildings had to live in disrepair. One of the banks in New York City that was financing many of these predatory equity firms was Signature Bank. Signature Bank was one of the most significant lenders to multifamily housing in New York City with an active portfolio of about 3,000 units, 3,000 properties with about 80,000 units, and a majority of those units are rent stabilized. Our panel of tenant leaders and organizers will discuss the tenant impact of Signature Bank's collapse. Signature Bank was shut down on March 12, 2023, after depositors withdrew large sums of money after seeing the collapse of Silicon Valley Bank. Regulators feared continued uncertainty in the banking sector and closed Signature Bank to try and calm the hysteria. Signature Bank's collapse has major impacts on NYC tenants. Our goal on this panel discussion is to deconstruct predatory equity, discuss what bad lending looks like, its impact on tenants living in those buildings, and what are solutions to prevent bad lending. So starting with the tenant leaders on this panel, I want everyone to introduce themselves, give us your background, and tell us about what led you to this panel.
Hi, I'm Adam Blazej. I'm a tenant in Inwood, the tippy top of Manhattan. And what brought me to this panel was for the past year or so, I've been organizing across a few dozen buildings owned by the same landlord, Sugar Hill Capital Partners, who was named #1 worst landlord in the city a couple years ago, #7 last year, so they're doing better. And yeah, we're here to learn more about how we can improve our our living conditions. Sorry, I'm a teacher, so learning conditions are on my mind.
Hi, I'm from Full-Time Tenant Union. I'm a tenant myself, organizing member of Full-Time Tenant Union. Full-Time Tenant Union is a multi-building tenant union operating within Watermark Capital Group. I was introduced to Signature and its involvement in multifamily property lending a day or two after the collapse on March 12, 2023.
Hi, everybody. Rolando Guzman. I'm the Deputy Director for Community Preservation at St. Nick's Alliance. We are a local community organization in North Brooklyn, and we provide several services to the community. Among those is tenant organizing and anti-eviction services. And we'll go into more details, but one of the reasons that we came to this world is because of the large number of tenants coming to our office with harassment complaints and housing issues, and that's how we started organizing tenants across different portfolios, fighting back so they are able to stay in their homes.
Hi, everyone. My name is Yonatan Tadele. I'm a tenant organizer at the Cooper Square Committee, just 10 minutes away from here. We're based in the Lower East Side, and we have been for the past 64 years, which is incredible. Like St. Nick's Alliance, we provide a lot of services for both tenants and community members, but the bulk of our work revolves around tenant organizing and predatory equity, which is a term that I think many of us, if not all of us in the panel, will talk about tonight. And so our work has really revolved around educating tenants on what that means and how that connects to their experiences in their buildings, but also supporting the community through just general tenant organizing. And I'll say a quick note that, like John Henry, I started out actually at Cooper Square as an organizer, but through ANHD's Community for Neighborhood Leadership program 10 years ago. So it's fantastic to come full circle and be here tonight.
Hey everyone, my name is Jacob Udell. I work at University Neighborhood Housing Program in the Bronx. I do research and data work there. What brought me here, I think, is just an appreciation for, and understanding that I think the role of lenders in rental housing in New York City and elsewhere, but in this case in New York City, is really underappreciated and misunderstood. I mean, I think that from all the work that we've done for years on this panel and lots of people in this room, we understand the ways that landlords who are predatory or negligent couldn't do what they do without the banks, and banks, are the largest investors from a pure dollar perspective in rental housing. They essentially co-sign lots of the bad behavior that landlords do in the city, and I don't think it's widely understood. And we've long wanted lenders to acknowledge that and improve their behavior. And I think the FDIC, the way that they're talking so far, at least, we're going to keep holding y'all accountable, has been talking the ways, in a way that we've wanted lenders to talk for a long time. And I think that it's a huge opportunity to keep pushing along this path with the former Signature portfolio for that reason.
And Jacob, you can hold on to the mic. So the first question is for you. In the 1970s, when the Bronx was burning, banks were disinvesting in low-income communities. Now they are overinvesting, speculating on properties in gentrifying communities with the goal of bringing in high-income people to take over historically non-white, underserved communities. Can you dive deeper into that? And also tell us, what do you think led to the collapse of Signature Bank?
Sure, I'll share a little bit about that, try to keep it short. So we really see the role of lenders as having when lenders are overfinancing, and by overfinancing meaning just like providing too much money to landlords, that translates into landlords having to make large mortgage payments out of the rents of the building, which puts upward pressure on rents because they want to be able to increase the pie, and also takes money away from upkeep and expenses on the building, right? And when we're able to see some of the data on these buildings, it's not uncommon to see mortgage payments that equal 40%, 50%, even sometimes 60% of the monthly income being generated by the building in terms of rent. So if anyone has ever been, I know a lot of you all have, if anyone has ever been in a older rent stabilized building in New York City, you know that those buildings take constant upkeep, and once you pull away out of rents half the money out the door going to the bank, there's just not enough money to keep up the building in decent condition. And again, it puts this upward pressure on rents. I think a lot of the reason why landlords are so interested in raising rents isn't only because they can pocket the extra rent money every month, but because that rent money translates in turn to the ability to take out a larger mortgage. For a long time that was known as a cash out mortgage or pulling equity out. So there are all these, we can spend a little bit more time on that part, but that there are all these dynamics where the type of loan provided has a real effect on tenants, has a real effect on living conditions in buildings, and has a real effect on landlord behavior. And Signature, in a world where all lenders were doing more or less that, Signature for a long time was the most egregious. You've heard a little bit about the portfolio and about the story of the collapse, but just to add a little bit of context, like anyone who's done tenant organizing in New York City has happened upon a Signature building or a formerly Signature financed building. And that's because they tended to finance lots of the worst actors in New York City. They did that because even in a world of pretty loose underwriting standards, our instinct was that they were the loosest in terms of being able to let landlords finance the future rents or at very low expense levels. And they've been a target of our work and ANHD's work for a long time, because of that. So that I think typifies a lot of their portfolio, and now we're in a situation of their collapse and the ultimate resolution of a final home for all these loans. Why the bank collapsed is a little bit of a question, I think, for all of us. Again, we could ask the FDIC maybe afterwards. Maybe they'd have more context. It's a little bit hard to say. They were There was obviously like a general fear about smaller local and regional banks and runs on their deposits, so that was happening. Signature had made lots of other risky investments, like they were really invested in cryptocurrency, for instance, so that was probably a part of it. But what we do know is that they had huge exposure to the rent stabilized market, and they made loans at high valuations in like 2015, 2016 through 2018 that for a lot of reasons, today no longer makes sense. And I think in everyone's mind, on the bank side, on the regulator side, and on the community side for sure, are over leveraged and over financed, and we think that probably had something to do with their eventual closure.
Thank you, Jacob. The next question is for both of the tenant leaders that are on the panel. So as tenant leaders that are currently in the fight, and both of you live in signature finance buildings, what are some of the challenges you have faced with your landlord, starting with Adam?
Yeah, so some of the, I think it's worth saying at a conference on responsible banking that the co-founder of the private equity firm that is our landlord, Sugar Hill Capital Partners, David Schwartz, he was previously an investment banker with ABN AMRO from 2006 2007, working on real estate securitization and structured credit products. You can put two and two together with where he's ended up. Again, as number one worst landlord in the city in 2021, number 7, 2022. So some of the challenges that we face, like in my case, I have 2 young sons, and one of my sons would have nightmares of rodents and cockroaches and pests. In our apartment, we had a bed bug infestation that they hadn't told us about, that a prior tenant had a bed bug infestation, and it displaced us during the one of the I think the Omicron wave. We had to find housing elsewhere because they had to do the work for the bed bug infestation that they had delayed. We didn't have hot water in some of our apartment for 2+ years. The elevator was faulty. We didn't have access to the super. We started talking to some of our neighbors. We learned that people were having similar issues, and that they had my neighbors had actually had a fight with the landlord, the same landlord, a few years prior to get the gas restored, the cooking gas restored in the building. It had been off for about a year. And yeah, so one challenge we face is just like, I think like Jean Henry had said, there's a high turnover in the building. So there is like a stable community of folks in the building who are there for the long fight because we don't have anywhere else to go in part 2. But yeah, like the community in the building changes pretty frequently, and so that makes it hard to, just to get to know one's neighbors. Our landlord, one thing they did across the portfolio, because we realized, like with my neighbors, we realized like we're going up against something bigger than ourselves. So we reached out to tenants of other buildings that they own across Upper Manhattan. They have a portfolio of at the time about 90 buildings or so, mostly rent stabilized buildings. And one thing that we learned that was common across all the buildings, like leaks, faulty elevators, and so on, is like that's common. But also, when they bought a lot of the buildings, when Sugar Hill Capital bought a lot of the buildings, one of the first things they did was they fired and evicted supers. Dozens of supers were affected by this, and I think maybe for people here, like that doesn't sound like a big thing. That just like that destroys communities. Because like this person who you would see around your neighborhood, you just no longer see because they're gone, and you no longer can like have easy access to that person, like in terms of like security of the building or like repairs. So I can't now access. I don't really have any access to our super. Our super lives several blocks away, and he manages well over 120 units, which is just not feasible for any one person. And yeah, I was thinking today when we all got that alert sometime in the afternoon, like we have the power to send an alert nationwide to everyone's phones, but I can't get a hold of my super. It doesn't make sense.
Okay, and so since the collapse, Full-Time Tenant Union has worked with organizations including ANHD's Equitable Reinvestment Committee to highlight Signature's decade-long support of predatory landlords. Our primary focus has been on gathering tenant testimony within Watermark's buildings. Turnover, as it's been mentioned here, is very high in watermark properties, and that's part of their business model. And after extensive outreach to over 126 of their 267 properties, we linked the turnover to infrastructure neglect, charging tenants for repairs, long delays in addressing repairs, and in some cases, refusal to make those repairs, false negative credit reporting, retaliatory rent hikes, security deposits not being returned, threats of credit reporting, rent stabilized buyout offers, construction harassment, minimization of maintenance issues, telling tenants directly not to call 311 for repairs, and the list goes on. We've also conducted a survey, and of the 75 watermark tenants who submitted the survey since March, we saw that 53% of them have been living in their properties for less than 3 years, and 30% of them for less than 1 year.
Thank you. So the next question is for both of the organizers on the panel, Rolando and Yonatan. So you were both seasoned organizers with a ton of experience organizing in New York City, especially when it comes to encouraging tenants to target banks in your organizing campaigns. So starting with Rolando, I want to ask you, what experience do you have engaging with Signature Bank before its collapse?
So I think everything goes back to the concept of predatory equity and community disinvestment as well. And I think in North Brooklyn, there was a pattern prior to 2003, for example. It was mostly rent stabilized with low income communities of color as tenants. And during that era, which was actually the housing burst, the housing boom as well, we start seeing companies purchasing more and more buildings and having very aggressive tactics to get a quick return. Harassment, displacement, and harassment taking many, many forms, from offers of buyouts all the way to actually having agents being in the buildings and terrorizing tenants at any time of the day. And one thing that we quickly learned, and I think that was very important, is that wasn't very isolated, that was a pattern. And that's when we started talking to other organizations. That's where we used the space of ANHD as well to start thinking a little bit more about this. And we came to terms that this is not just a landlord, it was basically a business model. And this business model also needed capital. And this capital was coming sometimes from non-traditional lenders, but a lot of times were from banks that they were well established in our communities as well. And that's when we started thinking like the banks should be more accountable. They shouldn't be just issuing a mortgage. And there is a clause when they sign a mortgage, that is the good cause clause, that the landlord commits to have the building in good condition. And that's basically kind of like saying, all right, you're responsible to keep the building up to code. But the reality is that we wanted to push the envelope a little bit farther and make the banks also accountable to this. So it took a lot of work for us as community organizers to start understanding and learning from each other about this new tactic, but more important, also working with tenants and empowering them and discussing this new business model. And that's when we started building coalitions. We start talking not only to one tenant from one building, but also the different tenants from different buildings owned by the same company. And that's when we started noticing, right, that the same lender was the same. There was consistencies. We started working with Signature, I want to say maybe 10 years ago, when we started seeing a couple players, really bad players actually, coming to our community, buying buildings over leverage, sometimes 2, 3, 4 times the price of what the actual income of the building can afford. And instead of even doing work in the building, they will start vacating, kicking tenants out, and having buildings nearly vacant. We were scratching our heads, how is that possible? What kind of business model is that? And that's when we started knocking the doors of Signature. And I remember having meetings with the board of directors, with staff from Signature Bank, and being very dismissive, actually. Not of us as community organizer, but of tenants complaining and sharing their experience of being terrorized, basically. And that's where we started strategizing a little bit more aggressively how to make this bank accountable. I think Jonathan can talk a little bit about the tactics that we use, but very important, I think that's the takeaway for us. It was a learning process not only as community organizers, but also an empowering process and a learning process that we also started with the tenants as well. And I think, Jonathan, maybe you can talk a little bit about like how we start putting pressure with signature back in those days.
Yeah, absolutely. I guess leading up to that, what Rolando mentioned was also our experience at Cooper Square. This is the neighborhood we organize in. Gentrification is kind of a soft term. I think when you talk about the amount of displacement, both of residential buildings, but also even of commercial businesses, small businesses in the neighborhood that have lost their businesses, people have lost their homes as a result of just this unaffordability crisis that has plagued the city. And what I saw when I first came to Cooper Square in 2013 was that, yes, we would talk about bad acting landlords purchasing swaths of buildings in the neighborhood. And you could name, on one hand, the landlords that own 20 or 30 properties in this neighborhood alone. But Signature Bank was the one constant. And I think in the context of how we look at that, I think as tenants, as organizers, Rolando mentioned the education, certainly that we needed as organizers, but we also needed to communicate to the members that we work with in the community, the tenants that we were organizing in our buildings. But for the most part, people don't look at the bank as a target. We look at our landlord or we look at our property manager when we think of, fixing something in our apartment, getting something, a service or what have you. So education was a big component of it. As far as tactics and what we needed to use, as far as, once we've encountered the bank, how do we get their attention, right? And what St. Nick's and Cooper Square and many other organizations around the city that are a part of ERC, but also tenant organizing groups all around the city, we organized. We hit the ground running, so to speak. And I think one of the things that we talk about in the context of our work is drawing attention to institutions through public action, demonstration, advocacy to city officials, elected officials, institutions at the higher levels of government, such as the FDIC, regulators at the city, state, and federal level. So those were all groups that we outreach to, both in a friendly way, but also in an aggressive way to kind of push the stories of what was happening on the ground. And I think what Adam and talked about, the conditions in buildings. So taking action that way, really leaning into the banks to not just meet with organizers, but meet with tenants, visit buildings, don't just hear stories and commit to making change, like actually see what we're talking about. When we talk about bed bug infestations, losing gas in buildings, ceilings collapsing as a result of unsafe construction, that's not something you can just mention and gloss over. People need to see that and people need to feel that in order to talk about what happens next. So really bringing the fight publicly to banks, doing actions and demonstrations, showing up at shareholders meetings, really pushing the message of the tenants forward that way.
And you can hold on to the mic because I have a follow-up question for both you and Rolando, and we can start with you, Yonatan. So I know that you both have experience developing campaigns and coalitions when it comes to targeting banks. So can you tell us about some of your successes and challenges in that work?
Absolutely. So once we began to identify sort of banks like Signature Bank, and started to realize that there was this connection between building conditions, predatory landlords, and financial institutions that needed to take more of an active role in being stewards of buildings. We talked about how do we come together, right? the stories that we're seeing in our neighborhood are constant in other neighborhoods as well. So as Rolando mentioned earlier, I think the first thing that we needed to do was partner with other tenants and other organizers, other organizing groups around the city to build power collectively, share stories publicly. And so I think that was a success in and of itself. I think we made predatory equity sort of a catchy term, I guess, in terms of kind of what we were doing around the city. So we defined that for our members. We had conversations around that. And we really sort of built ourselves into a coalition with the help of ANHD to really move forward collectively. So first and foremost, I think coming together internally, that was really important. In terms of other successes, I think of the public actions that we did, really pushing the envelope in terms of, how do we bring these institutions to the table where people on the ground, have not had power in terms of having a voice to bring these people to the table. So going out into the street, going out in front of buildings, speaking about conditions, speaking to the media about, all the crazy stuff that was happening in all the buildings we were working in. I think that had an effect. I'd mentioned shareholders meetings. We visited a couple over the years of signatures and made our presence known. We actually had 2 of our tenant leaders buy shares in Signature Bank, and so they got to actually attend the shareholders meeting and actually talk about their issues to Barney Frank and the rest of the board at Signature. So that was a super empowering moment for our members, and so that was also really, really empowering as well. And I think also having conversations with both signature banks and other banks, getting them to at least create agreements with us as to how they would steward buildings going forward. We can sort of talk about whether those were effective in the long run or not, but that was the first time that I think banks had really committed to taking more of a presence and sort of listening to tenants and taking an active role in building issues. So I see that as another success as well, creating those agreements and actually putting pressure on them that way.
I think one thing that I want to mention before is that I think from our point of view, our organizing work is not just against a bank. I think we value banks. I think they're a critical partner for community development, and they have a huge role in acquisition, maintaining, not only building new affordable housing, but also maintaining affordable housing. And I think there's a good way to do things and a bad way to do things. And I think that's a thing to keep in mind. I think going back to your question, I think the other part is that, housing is such an intimate thing, right? You go home, you take pride of your house. You start seeing pests. It's kind of like it's not only annoying, it's shameful, it's something so intimate. And when a tenant moves forward and goes to an office or talk to a community organizer, that alone is a big step, to be honest. And one of the things that we try to do is build community. So issues that are happening to one tenant in one building is very likely other people within the building is having the same issue, and very likely people in other buildings owned by the same landlord having the same issues as well. So that's where our motto is to do data research and identifying patterns. And I want to do a big shout out to Jacob and the work that you guys do providing data, because that data is the one that allow us to identify those patterns even before we send an organizer to knock a door and start analyzing data and start finding some patterns. That's so important for us, the data and real estate research. I think our experience, we've been somewhat successful building coalitions. And one of the things, again, is finding common denominators. And I can think of 2, for example. One is something that we collaborated very closely with Cooper Square is our campaign against Icon Realty. And that was a company that had a lot of rent-stabilized buildings in the lower Manhattan and also in North Brooklyn. They had the same pattern everywhere that they went. They would just buy buildings and destroy them, do very aggressive, disrupted, unsafe construction. And we organized a very articulated campaign against Icon Realty, and we were able to win. There was a settlement with the Attorney General, and tenants were able to get relief. More recently, and not so recently, actually, about 10 years ago, we start seeing a new player coming to North Brooklyn, Inc. Property Group, and this group of landlords, they start buying buildings a lot of times over leveraging, buying buildings 5 times the price. A lot of their mortgages were from Signature Bank, by the way, and they will have the same patterns: harassing tenants, threatening, sometimes using construction as a harassment, and keeping maybe 50% of the buildings vacant. And not only warehousing units, but leaving those units exposed to the elements. So tenants that still live in the buildings will complain about mold or leaks coming because the windows were open, and anytime that rain, the water will just go straight down, or pipes will burst because they got frozen during the winter. And that's when we started this coalition as well. And we brought those examples to Signature Bank, for example. We coordinated back then. We crossed paths in the Fifth Avenue Committee because they also had a lot of buildings in South Brooklyn. And we built this strong coalition of tenants, not only doing direct actions against Inc. directly, but also bringing their complaints to the banks and to the regulators as well. And I think that was very important. And I want to say maybe 2 years ago, the Attorney General actually finally came to a settlement with Inc. Property Group. And just reading over the settlement itself, some of the things that Inc. Admitted is making false claims to lenders, submitting false rent rolls, submitting false leases, and it kind of makes me think like what due diligence that bank did to make sure that they were actually lending money to somebody that actually can afford payback, right? And that's another example, and that's when we start thinking that Signature, something was off a little bit with their business model. But I think coalition building is something so powerful, and I admire you guys as tenants that you guys took the initiative organizing your buildings as well. And if there's any tenants in the floor, I really encourage you to talk to your neighbors and start doing some data research and uniting with other tenants from other buildings as well.
Thank you. And I quickly want to share one of my success stories when I was organizing in the Fifth Avenue Committee before I pass it on to the tenant leaders to share something. So I was also organizing an IC building. It was an 8-unit building, and there was one rent control tenant left in the building. All the other tenants were pushed out by buyout offers or construction harassment. And this tenant, like the walls were shifting, they were doing full gut renovations to every single unit around her. And we were able to partner with Take Root Justice to provide legal services, and they were able to get an agreement where she will be relocated to a different building while they fully renovated the building, and she was able to move back into the building and have a fully renovated, like pretty much market rate building and still have her rent control. So that's one of my biggest successes in organizing. And now for the organizer and for the tenant leaders, you both are core leaders that are developing tenant-led coalitions. Adam, you work with the Tri-Hill Tenants Coalition in Northern Manhattan, and you're working with the Full-Time Tenants Union in Brooklyn. So I want you both to share, like, what has been your organizing strategy, especially when it comes to, targeting banks and holding and communicating with regulators, starting with.
Sure. So I think I went into a little bit about our outreach to 260 so buildings for Watermark. Since then, we've implemented a few tactics that were basically suggested to us by ANHD and the ERC, and we wrote a letter to the FDIC, basically trying to capture what doesn't get captured by state and city agencies when tenants are dealing with fraud or maintenance issues. And so collecting that tenant testimony was just as valuable as some of the other data that's been collected and shared on the financial side. And it sort of paints a picture for the FDIC, for the next lender that gets control of these mortgage packages, and for banks lending to other landlords in the future. If they have a fuller picture of what tenants' experiences are in those buildings, they can determine whether or not that's a worthy candidate for that amount of money, and then also what that landlord intends to do with that money, whether it's to roll back into new property acquisition or to actually maintain the buildings that they purchased. So we're on the ground every month. We're hosting meetings every month. I'm trying to collect those tenant experiences and working with tenants to triage their individual circumstances. And it has not been easy. We're all tenants ourselves. We're all dealing with these issues. Obviously, something's gotten us to this point, gotten us to feel this passionately about our homes, our tenancies, and what options are out there if we lose even like the subpar conditions we are currently living in. So there's not a lot of prospects for me. I'm a native New Yorker. I moved from, not too far into the suburbs, just outside of Queens to Brooklyn, close to 17 years ago or more. And I've hopped around and it's pretty bleak. And rent stabilized units are being taken away systematically. And while the 2019 legislation has resolved that, it's resolved the hemorrhaging of that, there's been 2 decades worth of displacement and more, and destabilization and more that has yet to be resolved, and there's tenants kind of languishing in the aftermath of that.
Yeah, my mantra has sort of been to see the sort of change that we want to see. We got to build mass movements of people that can put pressure on those with their hands closer to levers of power. Yeah, saying this in a space like this just doesn't feel right. For some reason, and so so like a mass movement, I think, is what's necessary for real justice of working class people. So the bank thing has been difficult because we are just learning about who our landlord is. We're the Tri-Hill Tenants Coalition. Tri-Hill's the management company for lots of us, but they are just the management company, and they're like an affiliate, a property management affiliate of the owner, Sugar Hill Capital Partners. And so if you go to one of their buildings, I know a lot of people know who Sugar Hill Capital Partners is because all the organizing that we've been doing. But most people know the landlord is Tri-Hill, let alone like knowing who the banks are, right? And I think even when we learn, so part of what we do, I think, around the bank thing is like, not so like a tactic. We haven't got to this point of like pressuring the banks, but just figuring out, I guess, like politicizing around finance and housing, just like doing some political education, just figuring out what is a bank and what is the role of the bank in determining our living conditions. Just sort of like reflecting on, I think, what Jacob had said about how our landlords in general, can't do what they do without banks, and our landlord does bad things. They can't do bad things without the banks. And so I think that clicks for a lot of people, and then it just becomes a matter of like inquiring into and investigating, like, okay, well, like how do they, the banks, assist the landlord in doing what is they do? And we still haven't come up with like clear like tactic. And we did write letters to the FDIC. We did have conversations with them. To be honest, it's still unclear to us about what's going to be done. And I think a lot of people are just sort of like hopeless right now, to be honest, about conditions, because the landlord has been so shitty that there's not a whole lot of hope that the banks can or will do much. So I think so the question I get from a lot of folks is just like, okay, I know who the bank is now and that it matters, but what can they do? That's something we want clarity on, I think.
Okay, the next question is for Jacob. So you've been helping us a ton in the housing movement or the organizing movement with your research. And I really want to know, like, what is the strategy you feel we should implement across the city to ensure conditions are improving in signature finance buildings?
Sure. Yeah. I'll talk a little bit about that, but I just want to take a step back and talk about the work over the past few months a little bit. Also, is that okay? Yeah. So, right, just to give some context to all of this. So, we got a sense from early on at the from the FDIC that essentially, um, the more problems they saw in a given building, um, the more attention and effort they were going to put into addressing those, trying to address those problems as the intermediate lender, and then as one of the eventual longer term holders of the loan. We got the sense that the more issues in the building, the more basically obstacles they would put on the landlord, on their borrower, um, uh, and the better chance that we would have to sort of improve conditions, improve material conditions in all the buildings that we're talking about. So the last 6 months of our work has really been about trying to highlight, those buildings where we think conditions are worse, and that happened. We started by providing some data to the FDIC, but as everyone who works in housing, knows, you can't really know what's happening in a building without being in the four walls of the building and sort of understanding all of the dynamics. There's a lot that isn't captured by data, and so a lot of our work has been about trying to make visible the experience of tenants to the FDIC and help them understand what tenants are experiencing, both in ways that are captured by a housing maintenance code violation and in ways that aren't. So that's been a lot of our work, and everyone on the panel has been involved to a certain degree. A lot of people here who are not on the panel have also been involved, and that was sort of like ad hoc. We were just kind of doing it on a weekly basis with the coordination from Will from ANHD, thinking about ways to basically get things on the FDIC's radar. We would send, first we had to figure out where there was tenant organizing in signature finance buildings, which was a bit of a challenge, and we sort of worked to figure that out. And then we sent letters to the FDIC, collectively and individually. So we worked with individual tenant associations to send individual letters, and that ended up leading to these meetings with the with FDIC staff that's here today. And a lot of our work has been premised on the notion that the more information we can provide them prior to whatever the sort of longer term intervention is in these loans, the better positioned will then be to be able to continue to put pressure on the FDIC and whoever the FDIC's eventual partners in the loans are. So again, in terms of like what the strategy should be, as you heard Sean talk about, it's a really good thing that the FDIC is going to stay involved, in part because we know Sean and Alex, and they come to our events and they want to talk to us, and I think ultimately, if conditions worsen in some of the buildings, especially the buildings we've already brought to their attention, they're going to be allies in helping us think creatively to come up with solutions that actually make a difference. And we've spent, I think, a lot of us who've been working on the bank issue in housing for the past number of years have felt that there's sometimes lots of nice words said about how banks can be an ally. It's oftentimes less common to see actual material improvements, and part of the hopelessness is that Adam was describing is that that's across the board. Like, no one thinks HPD is going to do anything for tenants. No one thinks that banks or landlords are going to do anything, and like we're sort of seeing this as a new opportunity to bring another entity to the table with a different type of mission, different types of resources, and a different type of approach. And so far, we've been excited about that. So that's, again, just to give like a little bit of an overview. In terms of what else needs to happen, so the FDIC is now at the stage where they're marketing these loans to potential buyers, right? They want joint venture partners, they're calling it. Basically partners who are going to help monitor what's happening in buildings and service the loans. And we're really looking for other groups that are mission driven to be able to be those partners, who have the capacity and the expertise, right, to be those partners, so that when things go wrong in like a Sugar Hill building, as they inevitably will after the loans were sold, we'll not only have the FDIC to reach out to, but also another entity. And for us, especially when it comes to the buildings that we're all talking about and the buildings that we're organizing in, we're really looking to city and state entities to get involved. We know that they have been talking to the FDIC as well. We don't totally know whether they're prepared to make a bid on and become the lender on some of these loans, but in terms of who has the mission, who's got the resources and the capacity, and who we can most easily hold accountable, it's really got to be the city and state. And so we're sort of at this point a little bit turning our attention to what can the city and state do to help us, and that includes, I think, funding for tenant organizing and signature finance buildings. I mean, again, this is my bias, but I really think this is a huge opportunity for us to intervene with the FDIC's help in buildings that have otherwise really unsolvable crises in them, long deferred maintenance, issues that require a ton of money, lots of displacement, and all of a sudden we have this partner who who's willing to think creatively with us, up to and including if the landlord who are their borrowers are being intransigent or not working with us, to think about transfer of ownership, which I know lots of people in the room are interested in, and we think of as a sort of a more transformative intervention. So we need that stuff, and we need the city and state to be involved. So in terms of what strategies are going to work, it's going to be continued coordination, I think, among buildings that were formerly signature financed, a real focus on popular education. I think that this is a complicated situation, and we're talking about equity stakes and joint ventures. I've never used those terms as much in my life, and and we need to sort of make this the political stakes of it real, politicize it, as Adam was saying, and then I think, again, trying to get city and state entities involved and seeing this as an opportunity. The last thing I'll say is that I think all of us on the panel and everyone who's been involved in this, which has been again ad hoc out of organizers and tenants free time basically, this is potentially a model for other things that are going to happen in the future. Signature was the worst case of the stuff that we're talking about, but they're not that dissimilar from other banks who made loans at valuations that no longer make sense today. And there's rising distress, rising potential foreclosures. All that stuff is potentially happening. And what I think the things that we're talking about right now in this room around the signature portfolio present lots of options for future interventions in different cases. And I think that our work hopefully extends beyond just the few hundred buildings that we're going to really pay attention to within Signature's portfolio, to a situation in which landlords and investors have extracted profit from buildings that are in bad shape and on the backs of rising rents for tenants who can ill afford it for 2-3 decades now. And the chickens are coming home to roost, and we need to figure out how to ensure that people can stay in their homes, and that issues that have existed for years and years in lots of these buildings get addressed, and not just left behind, and for these buildings allowed to crumble.
Thank you, Jacob. So that concludes our panel discussion, and we're going to shift to having conversations in our tables. Will?
So we're gonna switch one thing up really quickly before. Yes, can we give them a round of applause, please? Yes. Okay, I'm not supposed to do wrap-up remarks, so I'm biting my tongue. I'm not gonna give wrap-up remarks. That's Will's job today. So, but one thing that we do want to do, okay. So I want to give a moment for us to recognize and give really brief remarks from Assemblymember Khalil Anderson, who has joined us. And the assembly member is also importantly the chair of the subcommittee on banking for New York State in the assembly. So this is one of the folks, like when we're talking about things that we've developed and figured out, which is best practices for multifamily investment and lending, and our elected partners who support that and help us get that through, and then take it from something that like we all figured out, right? These folks, I can't say we, these folks figured out, and put pen to paper on, that then we had elected officials who really stewarded it through government and is now something that is enacted and adopted by the Department of Financial Services at the state level. So the state regulator uses the best practices that this group of people created as part of their lending guidelines. And so if Assemblymember Anderson, if you can come up, we'll give him like a couple seconds, and then, but I just want to say thank you also to him.
Thank you so much. Let's give the panel another round of applause. And to our amazing hosts here at ANHD, I love this calendar. Every year I get it, or this graphic, every year I get it to my district office and I hang it up on my wall because it reminds me of the struggle and the fight to help protect the tenants and the working class folks who live in the 31st Assembly District where I represent in Southeast Queens. So I really appreciate you all putting this together. So as was stated, I'm the chair of the subcommittee on banks and underserved communities, and that gives us a tiny bit of oversight over state-chartered banks, right? Unfortunately, Signature had some pieces where they were state-chartered, some weren't state-chartered, or some aspects of their assets weren't state-chartered. So we are grateful that we had an opportunity to have a hearing up in Albany around some of the mispractices that the bank had, and hopefully we will continue to make sure that the other state-chartered banks that are in the state's portfolio, like M&T Bank, some of the others, are being good partners. So that being the chair of the subcommittee just give me a tiny bit of power over state-chartered banks and credit unions. So I'm really grateful for the work that you all have done in just fighting for working class tenants and homeowners across Queens. Some of the work that I've done in helping to support that, and I know I'm going to be short, I promise. I passed 2 pieces of legislation this year to help strengthen the Banking Development District program, which is a program that incentivizes individuals, financial institutions to get into a program to help serve underbanked communities. So we passed 2 bills on that this session. Really excited about waiting for the governor to sign them. She's got 2 more months to do it, so we're pushing her and her team on that. But ultimately, what's going to resolve this housing crisis is, 1, public banks. We need public banks here in the state of New York. Y'all can clap it up for that because we need that. We want that. But also, and I think one of the panelists mentioned this as I close, looking at ways that average citizens can own some of these buildings, right? HPD has the 7A, Article 7A program, as well as the AEP program. These are programs where nonprofits would come in and take ownership of dilapidated buildings, right? And these would hopefully be then financed by public banks so that all of these really important assets are not lost to folks who are looking to speculate like we saw with Signature Bank. So those are some of the things I'm working on as a state assembly member in the 31st District. I'm so glad to call you all as partners at ANHD, and I thank all the hard work for you guys that you guys do. Looking forward to continuing to partner, to build, to grow, and ultimately protect working class families. So pleasure to meet you all, and looking forward to just continue to listen. Thank you so much.
Thank you, Assemblymember Anderson. For those who don't know me, I'm Will. So you may have gotten emails from me. You may have met me in person, and maybe I've been to your tenant association. But for those who I haven't met in person yet, good to meet you. I'm the senior campaign organizer at ANHD. I coordinate the Equitable Reinvestment Coalition, known as ERC. That's been mentioned a few times tonight. Can we give the panel again a round of applause? I think they did really well. So you heard directly from folks living in Signature or formerly Signature Finance buildings, organizers directly that have been doing it for years, folks who have been monitoring it, doing the data work for years. This is, like Jacob said, this is a really important time to really think about how we can really take action and support to make sure that we get the conditions improved maintain affordability, and also see housing as a human right, not housing as for profit. If we can go back to the screen with the questions, that would be really helpful. Thank you. Yeah. So we've closed up the panel. I know we didn't have a section for Q&A, but we have some questions for post-panel. So the panelists will each sit on different tables. I know there's more tables than panelists, but maybe folks can join tables, or you can discuss in your own tables, thinking about these questions. Hopefully you can read them, but I'll read them out loud as well. So what can you do to ensure there are improvements and tenants live in safe and healthy conditions in their portfolio, signature portfolio? How can you support the tenants engaging banks when dealing with bad acting landlords? What do you want banks and regulators to do to ensure tenants are living in safe and healthy conditions? And after listening to the panel and hearing about organizing campaigns targeting banks, what are some of the best practices you think we can use now? But I also know that if you're in the table with the panelists, you're more than welcome to ask them a follow-up question. These are just guiding questions. It's not hard structure. This is also a part where we get to mingle and get to know each other. So spend a few minutes at your table, but also spend time to get more food, get something to drink, but also speak with each other. Thank you.